weekend, Lehman Brothers, one of the most venerable and biggest investment banks, was forced to declare itself bankrupt. Crisis talks are underway.
World financial markets are way down today following dramatic developments.
In 2008, the global economy teetered on the edge of collapse. Wall Street banks crumbled.
The Lehman Brothers made the largest bankruptcy filing in American history.
Homes were foreclosed by the millions, and average Americans watched their savings plummet.
We were told we would get in.
Stay open an extra hour!
It was the worst financial meltdown since the Great Depression.
Share prices continued to tumble in the aftermath of the Lehman collapse.
A storm born not of war or natural disaster, but of human greed, reckless risk-taking, speculative investments, and a housing bubble inflated beyond reason.
When that bubble burst, it hit home to probably 40% of the households in the country, these people that had mortgages on their houses.
As the crisis spread across the world, it revealed just how fragile the system was, exposing the cracks in capitalism. To understand why, we must rewind to the years leading up to the crisis. The roots of the 2008 financial crisis stretch back to the 1990s and early 2000s. For years, Americans were told that owning a home was the ultimate symbol of success. Politicians from both parties encouraged home ownership, believing it would build stable communities and expand the middle class. At the same time, the U.S. economy enjoyed relatively low inflation, falling interest rates, and technological growth after the dot-com bubble burst in 2000. When the Federal Reserve slashed interest rates to stimulate recovery, borrowing money became cheap. Mortgages were suddenly accessible to millions who previously couldn't qualify. Banks and mortgage lenders began writing subprime loans, mortgages offered to people with shaky credit histories. These loans often had hidden traps, teaser interest rates that would reset higher, balloon payments, or little verification of income. They were risky, but Wall Street had a way to make them look safe. Enter mortgage-backed securities and collateralized debt obligations. Banks bundled thousands of mortgages together and sold them to investors as bonds. Ratings agencies, trusted watchdogs like Moody's and Standard & Poor's, gave these securities glowing AAA ratings, claiming they were almost risk-free. Investors worldwide, from pension funds to foreign banks, bought them up, believing they were solid investments tied to the ever-rising U.S. housing market. But there was another twist: credit default swaps. These were supposed to act like insurance against defaults. Instead, they magnified risk. Firms sold billions in swaps without the cash to back them up if things went wrong.
A credit default swap was available to them, marketed to them as a risk-saving device.
Housing became the beating heart of the American economy. Home prices soared, construction boomed, and families borrowed against home equity to spend freely. It looked like a perpetual engine of growth. Yet beneath the surface, trillions in fragile debt and speculative bets were piling up, a house of cards waiting for a gust of wind. The 2008 crisis wasn't caused by one villain, but by a web of interconnected players.
Chuck Prince of Citibank famously said, "We have to dance until the music stops." Actually, the music had stopped already when he said that.
Institutions like Lehman Brothers, Bear Stearns, Goldman Sachs, and Citigroup engineered complex financial products tied to housing. They profited massively from packaging and selling risky mortgages while underestimating the dangers. Companies such as Countrywide Financial aggressively pushed subprime loans, sometimes fabricating income documentation or luring borrowers with deceptive promises.
It made it easier to sell the terrible investments if you could convince the buyer that not only were they going to get the investment, but insurance.
Ratings agencies like Moody's, S&P, and Fitch gave high ratings to toxic securities, assuring investors that risky loans were safe. Their business model, being paid by the very banks they raided, created a glaring conflict of interest. Government regulators like the Federal Reserve, the SEC, and other agencies failed to curb the excessive risk-taking. Deregulation in the late 1990s, such as repealing the Glass-Steagall Act, blurred the lines between traditional banking and speculative investment. Both Republican and Democratic leaders pushed policies expanding home ownership. While well-intentioned, these policies encouraged risky lending and overlooked a fragile system. Ordinary homebuyers sometimes took on mortgages they couldn't afford, betting that housing prices would always climb. Investors, too, ignored warning signs, chasing quick returns. Responsibility was shared. It was a culture of short-term profit, willful blindness, and faith that the system couldn't fail, until it did. By 2006, cracks began to show. Housing prices peaked, and adjustable-rate mortgages reset at higher interest rates. Suddenly, millions of borrowers couldn't make their payments. Foreclosures surged. Entire neighborhoods, particularly in states like Nevada, Florida, and California, saw homes abandoned. As mortgage defaults rose, the supposedly safe mortgage-backed securities turned toxic. Banks holding billions in these investments saw their balance sheets implode. Bear Stearns collapsed in March 2008. Lehman Brothers, once a titan of Wall Street, declared bankruptcy in September, the largest in U.S. history.
Lehman was about as close to like a free-fall bankruptcy, as experts would call it, than any other bankruptcy.
Panic spread worldwide as the 2008 financial crisis spiraled out of control. Stock markets plunged in rapid succession. On September 29, 2008, the Dow Jones fell 778 points, its largest single-day point drop at the time, after Congress initially rejected a bailout plan. Just weeks later, on October 15th, the Dow shed another 733 points, while the S&P 500 posted its worst weekly decline since 1933 on October 9th. Credit markets froze, meaning even healthy businesses couldn't get loans to operate. Ordinary Americans with retirement accounts and pensions watched trillions in savings evaporate almost overnight. In response, the government scrambled to stop the bleeding. On October 3, 2008, Congress passed the Troubled Asset Relief Program, or TARP, authorizing $700 billion to inject into banks and stabilize the system. Meanwhile, the Federal Reserve slashed interest rates to near zero and flooded markets with liquidity. Despite fierce public anger at bailing out Wall Street, officials feared the entire financial system might collapse without intervention.
Originally, what TARP was supposed to do, based on what Congress put into the bill, what Treasury promised, was to do more, of course, than just save the banks.
While banks were rescued, everyday Americans bore the brunt of the crisis. By 2009, unemployment soared to 10%. Millions lost work in construction, manufacturing, and finance. For many, stable careers disappeared overnight. Nearly 4 million families lost their homes between 2007 and 2010. Entire communities were devastated, with neighborhoods filled with for sale or bank-owned signs.
It's not easy to come in and move a family out. It's just our job to do it for the bank. It's just the nature of what's going on in the market right now.
The stock market lost nearly half its value from 2007 to 2009. Families saving for retirement or college saw decades of investments vanish. Beyond money, the crisis shattered trust. Many Americans felt the system was rigged, that Wall Street was protected while ordinary people suffered. This fueled political disillusionment and movements like Occupy Wall Street.
Shut down Wall Street! Shut down Wall Street!
Unlike previous recessions, this wasn't just about job losses. It attacked the core of the American dream: home ownership, stability, and trust in the financial system. The 2008 financial crisis wasn't a typical downturn. Most recessions are cyclical, triggered by inflation, oil shocks, or policy changes. This recession was systemic. It was rooted in the collapse of the financial system itself, not just one sector of the economy. The scale was global. European banks, Asian investors, and emerging markets were all tied to U.S. mortgage securities. The speed of the collapse was breathtaking. Credit markets froze almost overnight, threatening businesses far beyond Wall Street. Government intervention was unprecedented, from massive bailouts to near-zero interest rates and later quantitative easing. The 2008 financial crisis was often called the worst economic time since the Great Depression of the 1930s. Both shared similarities, but also striking differences. Both were preceded by speculative bubbles, housing in 2008, stocks in the 1920s. Both exposed deep flaws in financial regulation and oversight. Both caused widespread bankruptcies and economic hardship. However, in the Great Depression, the stock market crash of 1929 was followed by widespread bank failures, wiping out depositors' savings. In 2008, deposit insurance prevented such widespread bank runs. The Depression lasted a decade and saw unemployment soar to 25%. The 2008 crisis was severe, but shorter. Recovery began within a few years and unemployment peaked at 10%. The government response was different. In the 1930s, President Hoover resisted intervention until Roosevelt's New Deal. In 2008, massive bailouts and stimulus measures were enacted quickly to prevent a deeper collapse. In short, 2008 was devastating, but quicker government action prevented it from becoming another Great Depression.
Many of us felt like we were being asked to choose between the slippery slope to socialism and the next Great Depression.
By 2010, the immediate crisis had eased, but scars remained and the recovery was just beginning. The Dodd-Frank Act sought to reform Wall Street with stricter regulations, stress tests for banks, and oversight of derivatives. Still, critics argue it didn't go far enough. Politically, the crisis reshaped the U.S. landscape. Anger over bailouts fueled populist movements on both the left and the right, reshaping elections and trust in government. The deeper lesson of 2008 was clear. When unchecked greed and weak regulation collide, the consequences reach far beyond Wall Street. They ripple through the lives of millions, eroding faith in the very system meant to protect prosperity. The 2008 financial crisis was more than numbers on a spreadsheet or charts on a screen. It was families losing homes, workers losing jobs, retirees losing security. As we look back, the question remains: did we truly learn the lessons of 2008, or are the seeds of the next crisis already being sown?